Today we are going to see in business finance capitalization. Capitalization is an accounting method in which a cost is included in an asset value and expensed over the asset's useful life rather than expensed in the period the cost was incurred. Capitalization recognized as a cash outlay as an asset on the balance sheet rather than expenses on the income statement. Capitalization can also refer to the quantitative assessment of a firm's capital structure, the cost of capital in the form of a corporation stock, long term debt, and retained earnings. There are different types of capitalization. First one is accounting. The machine principle requires companies to record expenses in the same accounting period in which the related revenue is incurred. However, assets benefit a business over more than one accounting period and are often fixed assets like office buildings. The cost of these items are recorded on the general ledger as the asset historical cost. Therefore, these costs are capitalized, not expensed. Capitalized assets are not fully expensed against earnings in the current accounting period. A company can be a large purchase but expense it over many years, depending on the type of property, plant, or equipment involved. Second type is finance. Capitalization can refer to the book value cost of capital, which is the sum of company's long-term debt, stock, retained earnings. The alternative to the book value is market value, which depends on the price of the company's stock. Market capitalization is the number of outstanding shares multiplied by the share price. If total number of shares outstanding is 1 billion and the stock is currently priced at $10, the market capitalization is nothing but $10 million. Companies with a high market capitalization are referred to as a large caps. Capitalization threshold. Generally, a company will set capitalization thresholds. Any cash outlay over the amount will be capitalized if appropriate. Companies will set their capitalization threshold because materiality varies by size and industry. For example, a small business local store may have $500 capitalization threshold, while a global technology company may set its capitalization threshold at $1 lakh. Difference between undercapitalization and overcapitalization. A company can be overcapitalized or undercapitalized. Undercapitalized is nothing but when earnings are insufficient to cover the cost of capital, such as interest payments to bondholders or dividend payments to shareholders. Overcapitalization occurs when there is no need for outside capital because profits are high and earnings are underestimated. Moreover, now we're going to see what do you mean by capitalization. Capitalization is an important constituent of a financial plan. In common parlance, the phrase capitalization refers to the total amount of capital employed in the business. However, financial scholars are not unanimous insofar as the concept of capitalization is concerned. While some of them have viewed it in a narrower sense, others interpret in the broader term. It refers to the total amount of capital employed in the business. Financial scholars are not unanimous because so far the concept was since capitalization is concerned, as they viewed the narrowed sense bother interpret in the broader term. Majority of the financial authorities have used the term capitalization in the following sense. We also agree this concept of capitalization because the definition is free from any ambiguity and brings out clearly the distinction between the capitalization and its capital structure. However, worthwhile nothing that narrow concept of capitalization is different from the modern view, and the difference arises on the treatment of short-term debts as component of capitalization. This is called as capitalization. Thus, it according to